Most people are watching the silver price today and feeling relieved. They see a strong candle. They see headlines celebrating a breakout. They see numbers on a screen that appear healthy. But markets do not fail loudly at first. They fail quietly, inside the plumbing. Today's silver price is not the story, it is the symptom. The real story is hidden in the mechanics of the futures market, a place most investors never look and most media outlets never explain. In this documentary, we are going to slow everything down. We are going to remove the jargon, and we are going to explain why a rare and dangerous signal has appeared inside the silver market, one that historically shows up before stress, shortages, and major repricing events. This is not a prediction. This is not fear. This is about understanding how trust breaks and how markets react when it does. What people see versus what matters on the surface, silver looks strong. Prices recently moved sharply higher in a single session. Momentum traders see confirmation. Retail investors see opportunity. But price alone never tells the full story. Markets are like buildings. The paint on the walls may look fresh, but structural damage begins inside the foundation. In commodity markets, that foundation is delivery behavior. When participants are happy with paper contracts, prices move smoothly. When participants begin demanding physical delivery, something changes. And recently, something very unusual happened. How futures markets are supposed to work to understand what went wrong, we need to understand what normal looks like. Most silver trading happens through futures contracts. These contracts allow traders to bet on price without touching physical metal. As contracts near expiration, most traders roll forward. They sell the expiring contract. They buy a later month. They avoid physical delivery. Why? Because physical silver is heavy, expensive to store, and difficult to move. In a healthy system, almost everyone prefers paper exposure. This rolling behavior is what keeps the system liquid. And for decades, it worked. The rare event, backward rolling recently, that pattern broke. Instead of rolling forward into future months, a large number of participants did the opposite. They moved backward in time, into contracts that require near-term delivery. This behavior is called backward rolling. It is rare, it is expensive, and it makes no sense unless trust is breaking. Why would a sophisticated institution pay extra costs, accept logistical complexity, rush into delivery unless waiting itself has become risky? Backward rolling is not about price, it is about certainty. What delivery demand really signals when delivery demand spikes unexpectedly, it sends a message. It says, a promise later may not be honored. This does not mean default is guaranteed, it means confidence is fading. In history, similar signals appeared before currency crises, before supply chain breakdowns, before commodity repricing events. The key insight is this. When time becomes a risk, markets change behavior. Paper silver versus physical silver. Paper silver is unlimited in theory. Physical silver is not. You cannot print silver. You must mine it, refine it, and transport it. When investors stop treating paper contracts as equivalent to metal, the entire pricing model changes. This is when spreads widen. This is when premiums rise. This is when volatility increases, not because of speculation, but because of scarcity perception. The global connection, EAST versus WEST silver, is a global market. When prices diverge across regions, arbitrage normally corrects it. But arbitrage requires available metal, functional logistics, trust in delivery. When physical demand increases in one region, especially industrial hubs, metal flows toward that demand. This creates pressure elsewhere. Over time, prices must adjust to reflect reality. This process is slow until it isn't. Why does IT not resolve quickly? Trust breaks faster than it rebuilds. Once institutions begin prioritizing possession over promises, behavior changes permanently. Even if prices pull back temporarily, the signal remains. This is why such moments matter, not because of immediate gains, but because they mark transitions. What this means for viewers: the silver market is sending a message, not through headlines, not through price spikes, but through behavior. Backward rolling is not panic, it is preparation. It tells us that some participants are no longer willing to wait. They want certainty now. Whether silver rises or falls next week is not the point. The point is this: when trust changes, markets reprice reality. And history shows that ignoring these early signals is costly. If you found this explanation useful, please like the video, share it, and subscribe. This channel focuses on calm, factual financial documentaries, without hype, without fear, and without noise. Thank you for watching.